Hey everybody, this is Brent here, and I'm going to take a few moments and talk to you today about the tax proposals of Vice President Harris and former President Trump. Now, before I start, I want to add a huge disclaimer. I am not trying to be political here. For the most part, I try to avoid political discussions. However, tax proposals are a function of tax policy, which by its very nature is directly influenced by politicians, and meaning whoever's going to get in office here in November, whoever's going to be elected, is going to have a direct impact upon the tax returns that you file and the amount of taxes that you pay. So I just want to take a few moments and talk about some of the facts and some of the policies that they have and help you see and understand how this might impact you when you file your tax returns. I'm going to try to move quickly. I'm going to move fast. And honestly, I'm not going to dig real far into the details because I don't want to bore you with tax minutia. So with that being said, let's go ahead and get started. What we're not going to talk about today is the fiscal and the monetary impact of these proposals, but there certainly is an impact. Whenever you cut taxes but you don't cut governmental spending, it's going to increase the federal deficit, which is already at a ridiculous level. Right now, for example, today, and I'm recording this on Saturday, October the 26th, the debt is $35.8 trillion, which is just mind-boggling. It's hard to comprehend this and how much taxpayers and our children are going to have to pay back. So right this year, under this presidential campaign, there's a lot of deductions, there's a lot of credits, there's a lot of great incentives for taxpayers. But the question is going to be who's going to pay for all this? It is pretty clear that Trump's proposals are going to add more to the federal deficit than what Kamala Harris's are. So again, I'm not going to evaluate those things. I'm going to talk about the tax policies, but I will say, both of them are adding a lot to the deficit. So again, who's going to pay for all this? So that's the main concern I have with a lot of these proposals. There's some very good ones, but the question is going to be who's going to pay. And I'm not going to cover that. That's going to be a discussion for another day. Before we talk about the individual proposals of the candidates, let's go ahead and talk about the proposals that each of the candidates have on their websites. We'll start with Donald Trump, and in his case, he's talking about large tax cuts for workers and no tax on tips. We have a little bit more details about making the Trump tax cuts permanent with a little bit more verbiage here. Honestly, this is all that I could find on his website. There could be a lot more details out there on his website, and maybe I just missed it. That is quite possible, but this is all I could find on his website. Now, he has said a whole lot about taxes. He's got a lot of proposals that are out there, but this is all that's on his formal website. So the rest of the presentation, I'm extracting information from media sources. For example, the Wall Street Journal has discussed a lot about his tax policies. So I'm having to go to the media where they talk about what he said in rallies to kind of come up with what his proposals are, but this is all his website has. Let's contrast that with Kamala Harris. Her website has an extensive amount of information. Now, I think she's got fewer tax policies that are out there, but the policies that she has, she's got a lot more details that are out there. And honestly, when it comes to tax policy, it's very helpful to have those details so you can evaluate what the implications are. But this is just an example from her website. She's just got page after page after page of just details, and you're seeing kind of bits and pieces here. So we'll use this information to to compare the policies of both of them, to compare and contrast them. But you may want to go ahead and check out their websites. So let's go ahead and let's dive into this and let's get started. Probably the policy that's received the most attention in the media is the policy of no taxes on tips. Now, under current law, tip income is taxable to the worker. But under both campaigns, both President Trump and Vice President Harris both have suggested to eliminate taxes on tips. Now, Trump has said specifically he wants to eliminate the tips or the taxation on tips for restaurant and hospitality workers. And Harris has said she's mentioned service and hospitality workers. Now, what that raises the question of is obviously, the restaurant and hospitality is included. But when it says service, what's in the definition of that? Is that going to be like barbers? Are we going to expand this to the barbers and the hairdressers and hair salons? That's going to have a huge impact. But regardless of which candidate gets in, you're probably going to see a lot more businesses start shifting, if this policy goes through, start shifting more compensation from their pocket, moving it over to tips, which is going to increase the pressure on consumers to leave more tips, especially in areas that may not be tipped as much right now. Now, to me, the bigger question is not just the income taxes on this. What about Social Security taxes? And there's been proposals, not from the candidates, from the presidential candidates, but from people like in the House and the Senate. And there's policies on both sides of this. But what about Social Security taxes? In other words, yeah, if we don't tax this for Social Security, those workers are going to save a lot of money, but are they going to actually save it in the bank account and invest it for the future? Because if you're not paying into Social Security for decades and decades, you're certainly not going to get the Social Security benefits on the back end. So that remains to be seen. Another question relates to the earned income credit. In other words, if these wages don't count for income tax purposes, that's one thing, but will they receive credit for it for earned income credit purposes? The EIC is a very big proponent of our tax system that helps a lot of people out. And if they don't get credit, this could backfire and it could harm them. Another proposal that's receiving a lot of attention relates to Social Security. Now, under current law, Social Security is taxable, but there are various levels of income where it sets in. Under current law, if your income is below a certain threshold, then none of your Social Security benefits are taxable. Then there's another range, depending on whether you're single or married, where up to 50% of your benefits are taxable, and then a higher range where up to 85% of your benefits are taxable. So this chart is for single taxpayers, and here's the one for married, but you can kind of see these thresholds. So if you're single, if your income is over $34,000, then up to 85% of your benefits are taxable. If you're married, if it's over $44,000, then up to 85% of your benefits are taxable. I want to come back to these thresholds here in just a second, but let's talk about the history before we talk about the proposal. Basically, Social Security used to be exempt from taxes. Back in 1983, that's when the first threshold of 50% of your taxes became added to the tax law. And then in 1994, they added that extra 35%. And the law has been pretty much the same since 1994, to the best of my knowledge. Now, I think, however, those thresholds that we just talked about, I think they've been in place since these original laws back in the 80s and 90s. And I went back and checked. I can grab the data pretty easily going back to about 2000. And those thresholds have been the same since then. So what that means is that those thresholds, the 25,000, 44,000, 32,000, well, that impacted a lot fewer people way back in the day, back in the 80s and 90s, than what it does now. So I thought that was kind of an interesting observation. I don't think it's fair to current people that those thresholds were never indexed for inflation. So basically, as time goes on and inflation gets worse, we're having more seniors pay taxes on Social Security than maybe what the law was originally intended for way back when. I'm not sure, but that is what is happening. Let's put it that way. So basically, the proposal that's on the table is Trump has said, let's not tax Social Security. Let's eliminate the taxes on it. Vice President Harris does not have a proposal in this area. So if this does become law down the road, obviously the fiscal impact of this is very positive when it comes to taxation. So the fiscal impact upon one's individual income tax return. Now the impact upon the funding of Social Security is a whole nother issue. And again, we talked about that way back at the start of this. I'm not going to get into the funding of the government. We're just going to talk about the implications on your personal tax return. From a personal standpoint, this is pretty beneficial that will impact millions and millions of seniors. As a matter of fact, about 50% of seniors currently pay taxes on Social Security, so this has a tremendous impact on a large portion of our population. If this does become law, I think one of the things I'm going to be talking about with my particular clients is let's convert. Let's start converting your retirement accounts from traditional accounts over to the Roths. Not in every case, but in many cases. So we'll see how this goes, but this is a very interesting proposal nonetheless. Another proposal relates to the taxation of overtime pay. Under current law, overtime pay is taxable. However, President Trump has proposed eliminating taxes on overtime pay. Vice President Harris does not currently have a proposal on this. So regarding President Trump's proposal, there's not a lot of details on this. However, if all overtime pay becomes excluded from income for employees, this is going to have a tremendous tax savings. For example, right here in Georgetown, we have thousands and thousands of people that work at Toyota, and they receive a substantial amount of their compensation working overtime. So if all of a sudden all that income from the overtime is not going to be taxable, what you're going to have in addition to the immediate tax savings, what you're also going to have is you may find that many of those workers may no longer be in a higher tax rate. Instead of a 22% tax bracket, they may actually go down to a lower tax bracket, like 12%. So this does have a lot of potential for savings. It could be very beneficial for a lot of people, especially right here in Georgetown. Next, let's talk about the child tax credit. Under current law, the child tax credit is $2,000 for children under 17 and it's $500 for all other dependents. So if there's no changes to the existing tax law, then the child tax credit is going to be reduced back down to $1,000, which is what it was prior to the Tax Cuts and Jobs Act. And that reduction is going to take place on January 1st, 2026. Now, let's talk about the difference between a tax deduction and a credit. There's a huge difference between the two. A deduction means that you multiply the amount of the deduction by your tax rate, and that's the amount of taxes that you're going to save. But a tax credit is a dollar for dollar reduction in your tax bill. So if you owed $8,000 for taxes, you had 2 kids, both are under 17, then you get a credit for $2,000 for the older child, and you get a credit for another $2,000 for the younger child, which reduces your tax bill from $8,000 down to $4,000. So as you can see, this credit is worth quite a bit. So let's next talk about the proposals of the candidates. Vice President Harris's proposal is to increase the child tax credit across the board to $6,000 for a new baby's first year of life to help offset the additional costs of newborns, and $3,600 for other dependents. The $3,600 resembles the increased child tax credit that was proposed back during COVID. Now, this almost doubles the current credit and it triples it for newborns. So if the average household has 2 kids, you're looking at potentially receiving $3,600 for each child. That's $7,200 of credits. That's going to eliminate a ton of taxes. Plus, if you have a newborn, you add that to it. That's quite a bit. So that's a pretty big proposal there. Trump, on the other hand, as far as I can tell, I didn't see anything specific as far as his proposals that he has. J.D. Vance has mentioned increasing the credit up to about $5,000, but I can't find anything authoritative that points to that. I just saw a media reference to it. Now, former President Trump has referenced wanting to make the Trump tax cuts permanent. So that would keep the existing credit of $2,000 for children under 17 and $500 for other dependents. That would keep it at its current level versus decreasing it back to $1,000. So while I can't specifically find a specific proposal on this, there is definitely the proposal of not going back to the old laws and keeping them as they are. Regardless of who gets in office, there has been bipartisan support for increasing the child tax credit, so I would not be surprised to see one of these policies pass into law or to see the amount go up regardless of who's in office. Next, let's talk about the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act, which is sometimes referred to as the Trump tax cuts, was passed into law back in December of 2017, and it had far-reaching tax impacts. Millions of taxpayers have benefited from these changes, but they are currently set to expire in December of 2025. So what that means is, regardless of who takes office in January, tax hikes are coming in 2026, which could impact an estimated 62% of taxpayers, and on average, they pay about $2,800 of additional taxes. Those are complete estimates, but regardless of what the actual numbers are, the reality is, at least from my tax practice from what I've seen, taxes are going to go up, and it's going to be a noticeable amount. Typically, you don't really notice it when the taxes go down, but when they go back up, you start noticing it then. So without a new tax law coming in, the following changes are going to expire. First of all, you've got the lower tax rates. Right now, across the board, the rates are lower. That's going to go away. The standard deduction, where it got doubled from a few years ago, that's going to go away. We're going to go back to the lower amounts. We just talked about the child tax credit, how it was, it's $2,000 now. It's going to go back to the old rules of $1,000. And currently there is an outstanding business deduction, which is called the qualified business income deduction. It's for 20% of your net profit, and you don't have to spend a dime to get it. There's a little bit more to it, but more or less, that's a great deduction, and that's going to go away. And also, businesses can use something called bonus depreciation to write off equipment and a lot of their asset purchases faster. Overall, for the most part, the Tax Cuts and Jobs Act has had a pretty significant tax savings, it's been pretty favorable to most people. There were, however, a few people, there were people who lost out during this. For example, employees who have unreimbursed out-of-pocket expenses that are significant. So we're not talking about small amounts. We're talking about large amounts. These are people that are traveling all the time, or maybe their employer doesn't pay for anything and they have to incur a substantial amount of expenses on their own as a part of their job. All of those deductions just completely went away unless the employer started reimbursing them. So those are the people who really lost out on the Tax Cuts and Jobs Act. So without any specific action, these laws are all going to expire and they're going to sunset at the end of 2025. Next, let's talk about a few specifics. The current top tax rate is 37%, and Vice President Harris has proposed increasing that top tax bracket back to 39.6%. But you have to be making, under current law, over $600,000 if you're single and over $700,000 if you're married filing joint. And if you're married filing separate, which is a very unfavorable status, the current threshold is $365,000. So what's unclear at this time, and the answer may exist and I just didn't see it, the question is going to become, is that top tax rate going to set in at the existing thresholds, or is it going to only set in for if anyone who's making over $400,000 they're single, or if they're over $450,000 for married filing joint? The answer to that hasn't been released just yet, or at least I couldn't find it. Vice President Harris has also stated that she is not going to raise taxes on anyone making less than $400,000. Now, the challenge with this is that with the expiration of the Tax Cuts and Jobs Act on December 31st of next year, as we just talked about, taxes are going to go up for the majority of taxpayers. And so how this is going to play out if you're making less than $400,000, those details just haven't been released yet. So that's something, it's a question that needs to be answered, needs to be clarified. But that's been the proposal. That's the promise, is that we're not going to raise taxes on anyone making less than $400,000. Former President Trump, he proposes extending the Tax Cuts and Jobs Act and making them permanent. So as we just talked about, there's been a lot of favorable things for the majority of taxpayers. There were some items in that law that were not as favorable, but for the majority of taxpayers, this was a very favorable law, and Trump wants to make those permanent. The next item we're going to talk about is a change related to the Tax Cuts and Jobs Act. Under the old law, this is before the Tax Cuts and Jobs Act, about 30% of people itemized their deductions when they filed instead of claiming the standard deduction. So in other words, their deductible medical expenses plus their total taxes paid in, and that's what we're talking about here, plus the mortgage interest plus donations exceeded their standard deduction. But under the Tax Cuts and Jobs Act, the standard deduction was doubled, and the deduction for the state and local taxes got capped at $10,000. So you put all these together, instead of having 30% of the people itemizing, that number went down to about 10%. So under the current law, you only get a benefit for up to about $10,000 of the state and local taxes that you pay in through your wages, or the estimated tax payments, or your house taxes, or your car taxes. When you put all those together, you may have spent $20,000, but you only get a deduction for up to $10,000 on your tax return. So Vice President Harris does not have a specific proposal in this area. Former President Trump has proposed to remove this $10,000 cap on the state and local taxes, which would go back to increasing the number of taxpayers who could potentially itemize their deductions. On a similar note, let's talk about interest on car loans. Under current law, this is not deductible for personal automobiles. It is, however, deductible for business vehicles. As far as the proposals are concerned, Vice President Harris does not have a proposal in this area. Former President Trump has proposed to make car loan interest deductible. Currently, as we've talked about earlier, very few people itemize deductions, but if you increase that state and local tax deduction like we just talked about, and if you make car loan interest deductible as an itemized deduction, which is the proposal that's on the table, you're going to see a lot more people itemize deductions again. So this certainly helps provide a tax subsidy for what's a substantial or can be a substantial payment for many people. Next, we're going to talk about some proposed changes to the Earned Income Credit. Former President Trump does not have any proposals in this area. Vice President Harris, however, has a proposal to increase the maximum Earned Income Credit for workers without children that they can claim from the current limit of $600 to $1,500. Now, previously we talked about how beneficial a credit is because it is a dollar for dollar reduction in your tax bill. The earned income credit goes beyond that. Not only can it reduce your taxes down to zero, but it's what's called a refundable credit, which means you can actually receive a refund beyond your tax bill. You actually get the money back. Now, to be eligible for the $600 earned income credit under current law, we're talking very low income. And so increasing this credit from $600 to $1,500 could be very beneficial for the workers in these lower income brackets. Now, Vice President Harris's website has a sample list of people who could potentially benefit from this, and it talks about the professions and the number of people that are impacted. Our next topic has received quite a bit of media attention. Let's talk about the first-time homebuyer credit. Now, under current tax law, there isn't a tax credit for purchasing a home. There used to be one under a temporary program under President Obama back in 2008, which was during the time of the Great Recession and the housing crisis way back then. And during that time, it only existed for 1 year that I recall, and it was only for first-time home buyers, and they received a credit up to 10% of the purchase price of a home with a limit of $7,500. And if I recall, it was a credit that reduced their taxes, and it had to be repaid over the next 15 years. So it really resembled more like an interest-free loan versus just a free tax credit. Former President Trump does not have any proposals in this area, but Vice President Harris has a very interesting proposal that's received a lot of attention. Now, her website says, and I quote, that she will provide first-time home buyers with up to $25,000 to help with their down payments with more generous support for first-generation homeowners. So it appears that individuals qualify if they've paid their rent on time for at least 2 years. Now, how that's determined and administered will be a good question. This is a huge credit, and there's just not a lot of details on how this is going to work just yet. For example, who's going to be considered a first-time home buyer? There are areas of the tax code. There's one area I'm thinking of where it includes one definition of a first-time home buyer includes someone who's not owned a home in the past 3 years. Are they going to be included? Another question is this going to have to be repaid if the purchaser of the house moves before a specified number of years? If so, that could be really detrimental, especially if the house doesn't appreciate. And what does quote unquote a more generous support for those whose parents did not own a home mean? So things like that have not really been clarified. There's non-tax implications of this, such as, will this increase the housing shortage? Are we going to lose some of the benefits? Are the people who go take advantage of this, will they lose some of the benefits due to increased prices? Only the economists can weigh in on this. But from a tax perspective, a $25,000 credit is going to eliminate a significant amount of taxes. Regardless, this has the potential for a huge tax savings for those that qualify. For our next issue, there is a proposal related to business startup expenses. Business startup expenses are those expenses that are incurred before the business opens their doors. Expenses after the business opens, they're deductible in full anyway under current law. So this proposal relates to those expenses that are incurred before the business actually opens. Now, under current law, a business can deduct up to $5,000 of startup expenses and $5,000 of organizational costs on the tax return for the year that they start the business. Expenses greater than those thresholds are spread out and are deducted each year over 15 years. If the business owner spends more than $50,000 for startup expenses, the deduction they receive in the year that they starts getting reduced. Former President Trump does not have any proposals in this area. Vice President Harris, however, has a proposal that allows new businesses to increase the deduction from $5,000 to $50,000. Many new businesses incur losses in the early years of operation, so her proposal does allow for this and allows the business owner to claim the deduction in future years to reduce taxes at that time. This is a favorable additional deduction, and the flexibility to choose when to claim the deduction could be very beneficial depending upon how the law is written. Many very small businesses, such as mom and pop service-based businesses, don't have expenses that reach this level, so they really wouldn't benefit. So there's a lot of people that just aren't going to benefit from this. But those that are better capitalized and they are more serious about starting up and they have, a huge volume of expenses, they're the ones that potentially could receive some benefit, and this would be favorable for them. Our next topic has received a lot of attention, and this relates to capital gains. Capital gains have preferential tax treatment as they have a lower tax rate than what you pay on regular earned income, such as your wages or interest income. Those are taxed at your regular tax rates. Short-term capital gains are also taxed at your regular tax rates, but long-term capital gains are taxed at lower rates, such as 0% for some taxpayers, 15% for others, and 20% for higher income taxpayers. So let's first talk about former President Trump's proposals related to capital gains. I couldn't find anything specific on his website, but there were mentions in the media and online that maybe at a campaign rally he's talked about potentially lowering the top capital gains rate from 20% down to 15%, which that of course would be favorable. Vice President Harris has proposed increasing the top capital gains rate from 20% to 28% for taxpayers making over $1 million. So it's a pretty high income threshold. Now, this is the item that's receiving a lot of attention, and it's a pretty big deal. So Vice President Harris has a proposal to tax unrealized capital gains. Now, this is interesting because this is a fundamental change on how taxes work. Typically, gains are only taxed when the asset and security sold and cash exchanges hands. This proposal that she has says that those with a net worth over $100 million would pay a minimum 25% tax on the unrealized gains. In other words, the stock and the securities that they have not sold, if it's appreciated and they are worth more than that threshold of $100 million, they're going to pay a tax on that. Now, again, this is a big shift, and you might be thinking, oh my goodness, $100 million, this does not impact me, but I want to kind of throw out there how this very well could impact you. So let me demonstrate a way that this could potentially impact you. So Google's AI bot, Gemini, says that Mark Zuckerberg is worth approximately $206 billion, which is a mind-bogglingly huge amount of money. Since $206 billion is more than $100 million, he's going to be potentially subject to this tax. Gemini says that his net worth grew by about $84 billion in 2023. Again, that's a huge amount of money. So for illustrative purposes, $83 billion times 25% tax rate means he's going to have to pay almost $21 billion to Uncle Sam. While this seemingly doesn't impact you, it very well could. In order for Mr. Zuckerberg to pay about $21 billion in taxes, guess what he's going to have to do? He's going to have to start selling some Facebook stock. Now, Facebook is currently trading at $576 a share, or at least it is when I'm recording this. So in order to come up with $21 billion to pay Uncle Sam, he's going to have to sell about 36 million shares. Now, as of right now, the average volume is around 9.7 million shares. And so if you start having 36 million additional shares hit the market, what that's going to do is that's going to drive down the price of Meta stock. Now, I'm no economist, but if he has to sell all these shares and it's going to drive down the price of the stock, you're still thinking, I don't own Meta, that doesn't matter, how does this impact me? Well, Meta is one of the Magnificent Seven stocks that's held in the S&P 500. And so millions of Americans own this stock both directly and indirectly because through their 401k plans, they may have ETFs, they may have mutual funds that's invested in these large cap stocks or the Magnificent Seven. And so when you start seeing the share price of Meta drop because all of a sudden an additional 36 million shares are exchanging hands, and when you look at the other issues, in other words, for example, like the S&P 500, the top holdings of that are Apple, which used to be owned by Steve Jobs. It's probably owned by his heirs in many cases now. A lot of them are probably very wealthy. They would have to sell shares. Microsoft, guess who owns that? That's going to be Bill Gates. You've got Nvidia. I'm not sure who the owner of that is, but Amazon, Jeff Bezos, Meta, you've got Facebook. So Google, Berkshire Hathaway, these all have billionaires behind them, and you're going to see billions of dollars of taxes that have to be paid, and they have to sell their stock. You're going to see a reduction in the market value of all these stocks, which is going to hit your 401k plan. So that's something you just want to be aware of as it relates to this policy, because again, you're thinking, who cares? Let them pay their taxes, let them pay their fair share. Well, yeah, not only is it a fundamental shift in the way we tax, this very well could impact you. It's going to hit your 401k plan, and it's going to hit your IRAs. Something to be aware of. Here are two additional proposals from Vice President Harris that raise taxes on higher income earners. There are currently two lesser-known taxes that set in when an income exceeds $200,000 for single taxpayers and $250,000 for married taxpayers. Under current law, there's an extra Medicare tax of 0.9% that's paid on wages above certain thresholds, and Vice President Harris would increase the tax to 5% for those making over $400,000. There's also a similar tax called the net investment income tax, which is an extra 3.8% tax paid on investment income for higher income earners. Vice President Harris would increase this to 5%. Former President Trump does not have any increases or proposals in this area. For our final topic, let's talk about tariffs. And this is something that's been in the news more recently, and especially here as we get pretty close to Election Day. There's been a lot of talk about President Trump's proposals related to tariffs on purchases. He's talked about them at various campaign stops, and he's mentioned various levels for different countries. He's even hinted at replacing the income tax system with tariffs. Now, I'm an income tax guy. I do taxes all day long. I'm not opposed to getting rid of income taxes. They are insanely complex. But honestly, I think this is going to be pretty hard to do, and there's numerous reasons behind that. One of which is that the existing income tax system brings in a certain level of money, not enough to pay for all governmental spending. We won't go there, though. But under the tariffs, the income generated from that does not seem to be enough to pay for the existing expenses. Other reasons are things like low-income workers are getting off without paying a lot of taxes, whereas the high-income earners are paying a ton of taxes. Now, we're not talking about the ultra rich. We're talking about the bulk of taxpayers that are wealthy. They're paying a lot in taxes. Well, if you flip it to a tariff system, the reality is that you're going to see more taxes on the lower end of the spectrum and less taxes on the higher end, and there's just not enough money to pay for all the bills. I don't see it happening, but you never know. So here we are. We've made it to the end. Even though the presidential candidates have their policies as a part of their platforms, there still is a legislative process. Just because it's a part of their platform doesn't mean it's actually going to become a law. This reminds me of the Schoolhouse Rock video back from the 70s about how a bill becomes a law. It's a nice little cartoon. Well, again, we have a platform. It may end up as a bill, but just because it's on the platform does not mean it's a law. It still has to go through the process before it can become a law. So here we are. My goal was to show you how the candidate policies might impact you. I hope you found this helpful. It's not exciting. Taxes never are. But I hope you've at least found this useful to you. And I hope that you're able to go out and vote for your candidate of choice on Tuesday, November the 5th. Regardless of which side of you're rooting for, whether it's red, whether it's blue, both sides agree there's a lot at stake at this election. And what a tremendous blessing it is that we can select our leaders, and I hope that you can take a few minutes out of your time to exercise that freedom and go vote for who you think is best for this country. Thank you for listening, and I hope you have a wonderful day.